Advanced Financial Accounting. In this presentation, we're going to go through a practice problem for a consolidation where we have a parent-subsidiary relationship combining the books of the parent subsidiary into one with a consolidation worksheet. We will have downstream and upstream sales transactions that we will be having to deal with. We're going to be using a fully adjusted equity method. In other words, the parent will be recording on the books the subsidiary information using the fully adjusted equity method, which we need to take into consideration when we do the consolidation entries. Get ready to account with Advanced Financial Accounting. Here is the information we'll be using in our practice problem. We have P purchase percent of S. P is going to be the parent. S is going to be the subsidiary. Common stock on January 1st, 2000 X0. So the date of purchase, January 1st, 2000 X0. So the beginning of the year. Then the percentage of stock was 70% that P purchased. Therefore, there's a controlling interest that's over the 51. We will have a consolidation, but we'll have to deal with that non-controlling interest as well. The cost was $301,700. That's how much P paid for the stock, or the 70% interest in S. The non-controlling interest, fair value, we're going to say it's $129,300. So that's going to be the fair value at the point in time of purchase of the non-controlling interest. Then we have the book value of S, net assets at the point of purchase, meaning assets minus liabilities, book value, or the equity section as of the point of purchase, January 2000 X0, is the 395. Then we have the book and fair value same except for, meaning at the point in time of purchase, the book value was the same as the fair value except for there's a valuation of the land, which was higher by $14,000 at that point in time. Note we have land here, which is not a depreciable item, so we won't have to be dealing with a depreciation since that point, but we will have that difference. And then we have January 1st, 2000 X4. P inventory included unrealized intercompany profits recorded by S. This is going to be one of the new things that we will have here. So this, you can see that it's possible then, if you have a parent and a subsidiary, for two things to happen, right? You can have two things in terms of sales happening. You can have P selling inventory to S. You can have S selling inventory to P. And then, of course, you can have those two things happening at the same time. So these problems are going to be looking into those things and generally having two of those things happening at the same point in time. How are we going to be dealing with those? So usually when that happens, what the thought is, well, in the prior year, there could have been sales that took place between the two companies that hadn't yet cleared, meaning is there something that is in ending inventory as of the end of last year that is still on the books this year that we'll have to deal with? And then there's kind of like a timing difference we'll have to deal with. And then in the current year, what kind of sales took place between the two companies, between S and P? And, did any of the inventory that could have been sold between S and P actually get sold outside of the combined entity in the current year? So the assumption would typically be then, generally we would say, well, if there's anything from the prior year that was sold intercompany, so inventory sold from one company to the other, then whatever's still left as of the end of the year, we would assume, kind of like a first in, first out method, we would assume, it would have been sold in the current year. That's going to be kind of like the assumption typically. And then any kind of intercompany sales in the current year, then you would say, okay, how much of that is still left over on the ending inventory, possibly, that was a result of an intercompany sale at the end of the year. So typically when you look at these types of problems, then we're often looking at basically 2 years. We're basically looking at what happened last year, what was on the books as in regard to inventory from an intercompany sale last year, typically, and then what's happening in the current year, of course, and how much of that intercompany sale was actually sold ultimately to an outside individual, how much of it is still on the books as inventory at the end of the day. So we have here on January 1st, 2000 X4, inventory included. So we have the beginning of the year here, right? The beginning of the year, meaning as of the end of last year and the beginning of the current year, we're going to consolidate, which will be 2000 X4. P inventory included, meaning the parent company inventory included unrealized intercompany profits as of the beginning of this year. So those intercompany profits mean that S must have sold P the inventory in the prior year. So we'll have to basically deal with that. And of course, the assumption would be that P then sold that inventory that they have on the books in the current year. Also note, when you think about the terminology, if there's going to be a sale that's going from P to S, then we'll think of that as like a downstream sale, right? If it was sold by P to S. If the sale is going the other way from S to P, then it's going from the subsidiary up to the parent. We're going to call that basically an upstream sale. So just some terminology you want to keep in mind, because we're going to try to standardize some of the process to make this as easy as possible for the consolidation process. Okay, and then next we have on January 1st, 2000 X4, S inventory included unrealized intercompany profits recorded on P book of 15,000. So now we're saying, again, January last year, basically, these are items that happened last year that are on the balance sheet that haven't yet cleared yet. The inventory is still on the balance sheet now for S, meaning last year P sold inventory to S, which hasn't yet been sold. S hasn't sold it to an outside party, and we assume that the sale to an outside party, will happen in the current year, 2000 X4. And then we have both companies sold the ending 2000 X3 inventories to unrelated companies in 2000 X4. So that's the assumption that these beginning inventories that were a result of intercompany transactions, we're saying were sold then in the current year that we will be consolidated 2000 X4. So then during 2000 X4, S sold inventory to P. So now we're thinking about the current year that we're going to be consolidating 2000 X4, and this is what happened in the current year. S sold to P, so S is the subsidiary going to P. That's kind of an up sale that we would call it. It's going from the subsidiary to the parent. It's going to be a sales price for the 75,000, the cost being the 50,000. Then we have P. We have P held all the inventory purchased from S during 2000 X4 as of December 31st. So then the question is, of the inventory that S sold to P, how much is P still holding on to? And how much have they then actually sold outside of the organization? Because obviously, if we think of them as a group together total sum, then we're thinking about, did they sell it to someone outside? If they sold it outside of the two companies, then it would be an actual sale. If it's still on the books, then no actual sale really took place. And then we have during 2000 X4, P sold goods to S. So now the parent is selling it to the subsidiary. And notice there's kind of four things that are happening here. This is the most complex kind of thing you can think. You got it going both ways. P selling to S, S selling to P in the prior year, with ending inventory as a result that we're going to have to deal with in the current year. And then the current year transactions, both P selling to S and then S selling to P. So now we have P held inventory. So now we have during 2000 X4, P sold goods to S. So that's parent selling it to S. That's going to be a downstream kind of transaction, we're going to call it. And that means the sales price is the 111, the cost 66,600. And then S still holds part of its purchase from P on December 31st. So how much is still there? How much did they send out? We're saying that they held on 37,740. Now, note, again, a question could ask this either way. They could give this information either way. They could tell you what they're still holding on, or they could tell you what of the amount that they got they actually sold. We use the fully adjusted equity method. That's what's going to be used by P to account for their investment in S, meaning they're going to be accounting for the equity method we're typically used to, and we'll take a look at this shortly. And they'll also be taking into consideration these intercompany sales when they do their equity method. We'll take a look at those journal entries shortly. First, we want to start to consider those intercompany transactions. We're going to break this down into kind of like a standard type of formula format. It looks kind of long, but this is something that you want to just have in kind of a standard set format, like a lot of things in accounting. For example, like a cash flow statement. You start to kind of memorize just kind of which way things are going to be going when you put together like a worksheet. Same with creating a balance sheet or whatever. Similar stuff here. We want to get the format down, kind of get the standard structure down, and then you go into it more deeply and try to think about, okay, why does it fit together? And as you do that, you'll understand just accounting concepts in general better. So what we're going to do here is we're going to be breaking our information down to the current year and prior year activities, intercompany sales happening between parent and subsidiary. We're really going to be concentrating on just the current year in this problem. Then we'll take a look at the prior year more in a similar structure in another problem, because the prior information was kind of given to us in the example in this problem. So for example here, we're going to break this down, say that we have the downstream transactions for the current year. That's going to be the current year being the 2000 X4, downstream being parent to subsidiary. The sale happened going from the parent to the subsidiary. We're going to have three parts. That's why it's going to be orange here. that will be related to that. Then we're going to look at the upstreams transactions, those being from the subsidiary to the parent, the sale happening from the subsidiary to the parent in the current year. All right, so those are going to be our two transactions. I'm going to use our little ruler here. So let's start off with the downstream transactions. So we got current year downstream. That's going to be from P to S. So in our data, it said that we had sales from P to S for 111,000. So 111,000 is going to be here. The cost of goods sold, they told us, was 66,600. The difference between the two then being the gross profit. And then we can calculate our gross profit percent with the trusted calculator. 44,400 divided by the 111. That's going to give us the 0.4 or 40% as we see here. And then it could be useful to have the cost of goods sold, which would be 60% or 66,600 divided by 111,000. And there is the 60%. So then once we have that broken out, then we want to think about the amount that was resold. How much, so this is going to be the intercompany transaction that happened. How much of that was resold? So then we're going to say S still holds part of its purchase from P on December 31st. This was given in the problem. So they still hold on to 37,740. So of this then 111,000, and notice we're considering this in terms of the sales price here, not in terms of what basically S then sold it for, right? Because we're trying to consider of this amount up top, the sale, the cost of goods sold, the gross profit, how much of it was sold, how much of it still remains basically on the books in the form of inventory on S's books. So we're going to take that 111,000 minus the 37,740. That's going to give us the 73,260. Once we have that, we could say, okay, what's the percentage of that? We can multiply it times the 60% for the cost of goods sold, or 1 minus 40%. So we can say, all right, times 0.6. That's going to give us the 43,956. And then if we take the the 0.4 times that, or subtract this out, we get the 29,304. So then we want the difference then. We want the difference, and we want to say, okay, well, that means that within ending inventory, the amount that is left, and notice you might do this first too. You could say, okay, this first number here, the sales number, is this number, 37,740, which if you put that number here, then you can back into basically this number. And so I'm going to say, all right, so there's or you could do it this way. You could say it's the 111,000 minus the 73,260, and that's going to give us the 37,740 here. The cost of goods sold, I can multiply that times the cost of goods sold percent of 0.6, and that's going to give us the 22,644. Then subtracting these two out, we get the 15,96. So you can see how that works, right? We're going to say, here's the amount that was sold, here's the amount they resold, and then basically here's the difference that's being basically reflected on the books of S in the form in the ending inventory, in essence. And then, okay, so then that's what we have to think about, how we're going to reverse that. Now we do the same kind of thing for the upstream transaction. This is in the current year, upstream transaction current year, where we said that upstream means S sold to P. And in our data, they said S sold to P 75,000 sales. The cost of goods sold was the 50,000, difference 25,000. The cost of goods, the gross profit percent then being 25,000 divided by 75,000, or 0.3333, 1/3, and then the 50,000 over the 75,000. All right, and notice, be careful of the rounding here, because rounding, will cause minor differences. And then it says P held all the inventory purchased from S during 2000 X4 at December 31st. So that means that all of this inventory that was sold is still on the books. It wasn't resold. So none of it was resold. So that means obviously the difference between these two means that it's just the same, right? 75 minus 0 is going to be 75, and so on. So it's all reflected then in the ending inventory. Okay, so now that we have this information, we're going to put this into kind of like our standard little worksheet that's going to help us out with the first adjusting entry that we'll be doing, the consolidation entry that we typically do with our consolidation worksheet. So this is going to be our data then on the right-hand side where we've got P, we've got S, and we're going to be combining them together. These are the two sets of books we're going to combine together and then do the adjusting entry process for them. This is going to be our worksheet that's going to help us with that first journal entry that we'll be putting together. So typically that first journal entry has to do with the net income amount is going to be involved in it, as well as the net asset amount is going to be involved in it. So what we're going to do then is we're going to start then with that net income amount, meaning if I look at S's books, the net income is going to be revenue minus expenses. So we're going to say that they're reporting net income of this $44,000. That $44,000 then is going to be our starting point. That's usually our starting point for the first journal entry, and then we'll adjust it with these adjustments that we basically just figured out up top. And we'll put those adjustments in a standard way into our little worksheet here, and that'll help us to basically make our adjustments and make a journal entry that will be in balance and will work here. So, okay. So that means that we're going to take our $44,000. That's our net income that we would start with, $44,000. And typically we just break that out between the percentages, which I think was 0.8, was it? It was 0.7. It was 44,000 times 0.7 was the controlling interest, because we purchased a 70% interest. And that means that the 30% interest, 44,000, is the non-controlling, 0.3. So we're breaking this out 30-70. 30-70, that's what we normally do. And then we're going to make our adjustments to it. We're going to do the same thing on the balance sheet side. So we got the net income here, then we'll make our adjustments. Then we're going to think about the balance sheet side and break that out between the controlling interest and the non-controlling interest, controlling, non-controlling interest here. So this is the other side of the entry. Notice the meat of it. This items will be basically the same. This item dealing with the net income side, this item dealing with the balance sheet side. So in other words, balance sheet side, we can calculate two different ways. This is our balance sheet as of the current time period, 2000x4. If we pulled out the trusty calculator to make it a little bit bigger, and we would take assets minus liabilities, we'd say, all right, 91,000 plus the 5,000 plus the 127,000 plus the 261,000 minus the 23,000. That would give us the 461. That's our starting point, which also, of course, equals equity, which we can calculate down here, all the blue ones. 165,000 plus the 258,000 minus the 6,000 plus the 211,000 minus the 140,000 minus the 27,000. That's going to give us the 261 as well. That's our starting point. We're going to break that out 70-30. So we're going to take that times 0.7. That's going to give us our 322.7, and we'll take the 461,000 times 0.3, and that'll give us our 138.3. So that's going to be our starting point, and then we'll plug this information we worked up top into this worksheet. So let's do that now. I'm going to scroll down and we'll do that here. So here is our information. Okay, here we are with our worksheet again. Same worksheet, non-controlling interest, the P's portion, and then the total. We had the 44,000. That's the net income for S that we broke out 70-30. And then we got our information, some of the information we put together before, and some of our information from the problem that we're going to use to calculate now. So now we'll do our standard calculations. And this side you always want kind of the same, right? We're gonna have these headings here. So then we're gonna put in our standard type of process. We're gonna say, all right, reverse growth process deferral down. So that's gonna be, we're talking about down, meaning we're talking about a transaction that went from P to S. This is basically a prior year transaction. So you're thinking about this as something that happened prior to the year that you're consolidating in. And then that was given to us in the problem where it says, January 1st, the beginning of the year, meaning this happened, the transaction that happened at last year that resulted in the ending inventory in the current year was 2000 XP. P inventory included unrealized intercompany profits recorded by S of 42,000. So there's the 42,000, and then this one is the one we want. January 1st, 2000 X4 S inventory included unrealized intercompany profits recorded by P. So if it was on S's inventory, in S's books, it must have been a sale that went from P to S, which is going to be the down sale here. That's why we know that we're going to be picking this one up. That's going to be the 15,000. So we'll pick up the 15,000. I would start putting it in the total. And then for this one, because it's basically the downstream, we're not breaking it out 70-30 like you might think. You might think I'm going to break everything out 70-30. No, it's the downstream one This one we're going to be putting directly into P. So the whole thing's going to go into P. Then we're going to go to basically the prior year. So again, I'm breaking this out, prior year transaction that we're talking about, the upstream transaction, meaning went from S to P. Now we're talking about a sale from S to P that happened in the prior year, prior to the year of consolidation. So January 1st of 2000 X4 P inventory included unrealized intercompany profits. So this was on P's books as of the beginning of the year, so the end of last year, which means it must have been a sale from S to P, the total there being the 42,000. So we're going to say, okay, so our standard process, we're going to say 42,000. And this one, since it's an up transaction, is going to be broken out in accordance with our 70-30 split. So we got the 42,000 times 0.7. That gives us the 29.4 here. And then we've got the 42,000 times 0.3, which gives us our 12.6. So that's going to be that. And then the next component of this is then we're going to say this. Now we're looking at kind of like the current year things that happened, which we did with our little colorful worksheet on the right. So gross profits deferral down, meaning we're talking about current year intercompany transactions that went down, meaning from parent to subsidiary, parent sold inventory to subsidiary in essence, where we said, here's the sales, here's the resale that happened, and then this is the number we're looking for, that 1596. Because it's, so that goes here, it's going to be a subtraction, so we're going to reduce here. Because it's a down transaction, it's all going to go to P. We're not going to be splitting between the two. And then we have the gross profits deferral up. So now that's going from, so that's going to be going from up. It's going from S to P, and that's going to go from here, right? That's here in the current year transactions. So we're picking up this 25,000 here. That one, because it's an up transaction, we will be splitting between the two. So a 70-30 split, 25,000 times 0.7 is the 17.7 here. And the 25,000 times the 0.3 is going to be the 7,005 there. Then, of course, we can total this thing up. We can just say, all right, let's total it up. That'll be fun. Calculator work here. So I'm going to say that's going to be the 44,000 beginning net income plus the 15,000 plus the 42,000 minus the 15,096 minus the 25,000. That's going to give us our 60,095. And of course, if we totaled up P and the non-controlling interest, we get the similar thing. We would have had the original breakout in our original journal entry would have been for 30,800, but we're adjusting it by the 15,000 plus the 29.4 minus the 15,096 minus 17,500 for the 42,604, which will be included in our original journal entry, or in our first journal entry typically for our consolidation entries. So now what we're going to do is we're going to scroll down and we're going to take this same thing that we just did. We just put this table together and now we're going to do the other side of it. So we looked at the income side of it. Now we're going to be looking at the balance sheet side of it. Basically the calculator of the net asset side, which we said was the 461. Now you would think this would be tedious or difficult, but it's the same thing. So the meat of this table, we're going to say, okay, now let's look at basically the net assets, which added up to the 461, which we broke out between the 70-30, which would be our normal consolidation entry. But now we're going to adjust it, and the meat of this is just going to be the exact same, right? I'm just going to take these numbers that we just did, the same, all of it from here down to here, and that's just going to be the same filler down here, right? So we just filled in the same numbers, and so now we're just looking at basically the other side of the transaction. And so that means that this would have been included in our original consolidation entry. Now we are adjusting it to this amount. And because we did a similar adjustment on both sides here, right, that should help us to balance out when we do this in our journal entry, which we will see shortly. So this is going to be the balance sheet side of things. All right, let's scroll on down. Okay, so now we want to consider our normal kind of calculation for the book value calculation to see if there's any goodwill that's going to be involved. So this is our goodwill type of calculation. This is the information from the problem for the purchase that took place, and then our normal calculation. We're going to start with the book value of S. This is as of 2000 X0 when the purchase took place was 395,000, and remember that would be assets minus liabilities, basically book value or equity section at the point in time of purchase. Then we said that the 14,000, there was an increase of 14,000 due to land, which had a larger fair value than what was on the books for. Notice it's not a depreciable asset, so we don't have to deal with depreciation for this problem, which is nice. That means the fair value at the point in time of purchase, 2000x0, was 409,000. So then we had a non-controlling interest, which is given to us here of the 129,300. So 129,300 minus the 409. So the 409 minus that means that you would think that the controlling interest would be the 279.7, and you would think that that would be what we paid for if there were no goodwill. However, we paid for it the 3017. So there's the 3017. That means there's goodwill of 22,000. So there's goodwill with regards to this problem that we'll be dealing with for that 22,000. Okay, so now we're going to go in and we're going to think about the equity method. How would we calculate the equity method? And then we'll finally get to the consolidation worksheet, which is, of course, what we've all been waiting for here. So in any case, now we've got the fully adjusted equity method that we want to think about. Now, when we think about, how are we going to do this consolidation? We're going to combine the P and S's financial statements. We're going to combine the trial balances together here like we normally do. And then we'll have to consider how to do the elimination entries. To do that, we want to think, okay, how did they get to this 315, 304? That's going to be using the equity method on P because that needs to go down to 0. So we want to deconstruct that in essence. And we want to deconstruct this one because, again, this was created through the equity method. P accounting for the equity method of S for that 42,604. So we want to deconstruct that. So we're not going to post these accounts. What we're going to do is try to figure out and back into these two numbers. We're not going to back into this number specifically because that number, we're only going to do the current year transactions. But we will get to this number because this number only represents the current year transactions. So we're going to do the fully adjusted equity method, meaning we're going to actually adjust for what S recorded, the subsidiary, and for these consolidation effects that will take place, including the intercompany transaction within our equity method calculation. All right, so we'll start off with our normal equity method calculation, which is simply to take the net income. So we're going to say, all right, S had net income of 44,000. So we'll take the old 44 times 0.7, because we have 70%. That's going to be the 30,800. So there's the 30,800. That's going to increase or debit the investment and increase the income from S. Then the next standard equity type of thing is to say, okay, what about our portion of the dividends? S had dividends of the 6,000, so we'll just take the old 6,000 times 0.7, 70%. There's the 4,200 on the dividends. That's the standard equity method. Now we want to look at those things that aren't so standard, right, on the equity method. And we're going to say, okay, so this is the new thing. We have our worksheet that we put together. So this is our worksheet where we took the net income, that 44,000, and we broke it out. Now, if we're going to reflect this adjustment in our equity transactions, then we'll have to adjust them with our journal entries in our equity method. So we'll take this worksheet and basically adjust it. And so the first adjustment here, we're going to say investment in S is going to be debited, income from S credited, for this reverse gross profit deferral down where we have the 15,000. So that's going to be part of our equity method transactions. That's going to be part of the creation of those accounts that we're going to be reversing now and making 0 in the adjusting process. Then we have this item, which is going to be the income from S debit and the investment in S. That's going to be from the gross profit deferral down. So notice what I'm doing here is I'm grouping the down transactions. The down transactions are being grouped here. This is the down transaction in essence for the prior year. For the prior year, this is the down transaction. In other words, the sales that took place from P to S in the current year. And so you can see these are kind of opposite transactions that are happening due to them. And then we're going to go, okay, now let's take a look at the up transactions. The investment in S is going to be debited and income from S for this reversal of the gross profit deferral, basically last year, up transaction, meaning going from S to P. We're going to be picking up this line in P's column, not the total, the 29.4. And then finally, we will do the income from S. Notice again, these are kind of equal opposite transactions. 17.5 investment in S, the 17.5. This one should be blue here if I was doing this all the way I wanted to do it. But gross profit deferral up. So now we got the up transactions. Again, the two up transactions, this being the up transaction in the current year. Okay, so now let's add these up. And basically, I'm color coding these by investment in S and the income from S to see what happened in the current year with the equity method. We're trying to reconstruct these two accounts that are in yellow. So if I take a look at the investment in S in green, that included this and this and this and this and this and this and that, all right? And that adds up to the 38,404. That doesn't tie out to this. Why? Because this is a permanent balance sheet account, and we've been doing this for like 4 years now or something. But that should be that should be what happened to it in the current period. You know, if we looked at the GL account, and then here we got the 42,604. That's going to be this, 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 and this, and that does tie out. So that means this needs to go to 0 within the consolidation process, and we can use this method to kind of deconstruct if we have problems when we go through the consolidation and think through exactly what is going on here. So now we're going to put together our journal entry. So now we're finally to the journal entry standpoint. We're going to say, all right, here's P's books, here's S's books. We're going to total them up just like we normally would. And then we're going to enter our consolidation entry here. So this is going to be our consolidation process that we will be taking place. At the end of the day, this should go down to 0. This should go down to 0. Our first consolidation entry typically deals with this investment account, the basically S's equity accounts typically, and then the income from S accounts are the things that we will typically be dealing with. So I'm going to say, okay, the investment in S, we typically have to deal with that. That'll be a credit. Now, imagine that I didn't put a number there yet. I'm going to go back and we'll calculate that later. But I always put that first for what it's just a habit I have in essence. And then we're going to be dealing with these common stocks from S, meaning we're dealing with the equity method, the equity accounts for S. So the common stock has the 165,000 in it. It's a credit. So we're going to do the opposite thing to it, debiting it. The result of that, once we post it, notice we have the 197 plus the 165. That's a total of the 362. Then we're going to subtract out once we post this item here, which it's already posted. Here it is. And that's going to give us the 197,000 back to basically the original number. Then we're going to go down to the retained earnings. So retained earnings, that had the 258,000 in it. We're going to remove it. We're going to debit it to make it go down. So if we post that, when we post that as we have here, the 564,000, the 258 gives us the 822 minus the 258 back to basically the P's portion, just like we've seen in prior problems. Then we have the dividends, 6,000 credit here for debit here. We're going to credit it to make it go down. So we have the 32,000, the 6,000 for 38,000. Then we're going to credit the 6,000, bringing us back down to the 32,000. Then what we're going to be dealing with are the other accounts that will typically be involved is usually we decrease the income from S. Then we deal with the breakout between the non-controlling interest for the income statement and basically non-controlling interest for the balance sheet. So let's think about those items, and we're going to be using our worksheet down below in order to do so. Normally, what we do here is in our first journal entry, a lot of times we're going to say, all right, I'm just going to, take kind of like the book value of this. So what I'm going to do is I'm going to say, I would take this 44,000, the 44,000 times the, if I'm looking at the controlling interest, this one would be 44,000 times the 0.7. And that would be, I would be putting the 30,800 there. And you can see in our worksheet, there's the 30,800. But now we adjusted it with these adjustments because these were included in our equity method calculation to the 42,604. So that's going to be changed to the 42,604. And then this non-controlling interest in the net income normally would be the 44,000 net income down here times the 30%, the 13,200, which is on our worksheet here. But now we adjusted it to be that 18,300. So now we adjusted that to be the 18,300 we're going to put there. So that's our change. And then this non-controlling interest in the net assets, normally we would take, all right, the net assets of S were 91,000 plus 5,000 plus 127,000 plus the 261,000 minus the 23,000. There's the net assets, which tie out to our worksheet here. And then normally we would take that 461,000 times 0.3, and that's for the non-controlling interest, and that would give us that 138, which would normally go there. But now we're breaking it out this way. We're changing it to that 143 in accordance to the worksheet. So there's the 143, and then normally this investment would be that 461,000 times 0.7, the controlling interest. The 322.7 would normally go there, but now we changed it to the 334,405. So in other words, so you can see how this first entry has basically been adjusted with our table there. So we got the meat of this, the internal portion of this is basically still being broken out 70, between the 70 and the 30. In other words, if I took the 165,000 plus the 258,000 plus the 42,604 plus the 18,300 minus the 6,000, meaning all the middle here, that comes out to the 477,904, this 477,904, which we're then breaking out between the portions 70-30%. So times 0.7 is going to be the 33,500, right? The 33,504, and so on. So that's going to be our first entry. That's kind of like the biggest hurdle for us to kind of get through typically. So then we're going to go on. Now, obviously over here, we're reflecting it being posted. So you can see the change that we happen here. This hasn't gone down to 0 yet. This is at 0 at this point in time. And this is the transactions that took place from this entry. Okay, so the next entry we're going to do, here's the first entry again. Now we're going to be concentrating in on this entry, which we have seen basically before. This is going to be us putting on the books, calculating the depreciable asset, which actually was land, wasn't a depreciable asset. Maybe property, plant, and equipment would be a better name. But we said that the 14,000, there was an increase of 14,000 between the fair value and the book value. So we're going to be putting that on the books during our consolidation. So there's the 14,000. We've seen that before. It's going to go into the depreciable assets. This again, this is land, that it's including non-depreciable land. Okay, and so there's the 14,000 increasing to the 556. So this column representing everything up until this point in time, including the first journal entry we had here, and now this 14,000. So this was our consolidated entries, our consolidated process before entries, consolidated entries here, ending balance. Then we have the goodwill. Goodwill we calculated to be the 22,000. So we're going to be including that with a debit. That's going to be an asset. So no goodwill was on the books before. We're going to be adding the goodwill. So there's the 22,000 there. And then we're going to be breaking those out. These are balance sheet accounts. So notice we're breaking them out between the two kind of balance sheet side of things, meaning the non-controlling interest for the net assets and the investment. So controlling, non-controlling, versus the income statement side of things, which would be income from S, non-controlling interest in the net income. So I'm going to take this 22,000 plus the 14,000, giving us the 36 times 0.7. That's going to be the 25.2. And then if you did the same thing for the 14,000 plus the 22,000 times 0.3, that's going to be the 10.8. So then we're going to be posting this to the investment account here. It's included in there. Other things, everything's been included up, whatever's included up to this point. And then the non-controlling interest is going to be here. It's included in this item. So again, these are the two transactions that have been recorded in this column thus far. All right, scrolling down, next entry. So the top two entries represent the two entries that we've entered so far. This is the entry we're going to be working on now. So now what we're going to think about now is those intercompany transactions and kind of reversing the intercompany transactions. So this here is our worksheet, you'll recall, that was breaking out the net income, the 44,000, between P and the non-controlling interest. We're looking at the two items up top, which are basically the prior year items here. So we have the downstream and the upstream from the intercompany transactions from the prior year. So we're going to be taking that information. We're going to take the cost of goods sold. We're going to be crediting the cost of goods sold. So we're going to credit the cost of goods sold for the 42,000 and the 15,000 for the 57,000. So that's going to be the credit of the 57,000. Then we're going to debit, not in accordance with the 30-70 split, but in accordance with the allocation of P, the controlling interest and the non-controlling interest. So the investment in S lining up to P, So the 15,000 and the 29,400 then being the 44,400, and then the non-controlling interest for NA then being the 12,600. So there's going to be this transaction, in essence, reversing part of the cost of goods sold due to the intercompany transactions result from the prior year that we're taking and we're pulling from our worksheet. The other side of that then, again, breaking out between these two sides. Again, the balance sheet side kind of accounts up top, right? The investment account, the non-controlling interest, as opposed to the income statement side of accounts being the income and the non-controlling interest in the net income. So posting those out, then it's going to have an effect here on the cost of goods sold. And then we had an effect in the investment up top, which is now brought down to 0. So that's a good indication that we are on a good track. And then the other side going to the non-controlling interest here for the 32,000. Okay, let's scroll down to the next one now. So we have the entries that we've done thus far up top, and now we're going to be entering the new entry down below. So now we're basically going to be reversing the income transaction that happened in the current year. So you could see down below, that's the main thing I would be focusing in on. So if we took out some of the information that we had when we put together our transactions, the colorful worksheet for the 2000 X4 downstream transaction and the 2004 upstream transaction, meaning the current year transactions, and we take this 111,000 sales that happened from downstream, intercompany, and the upstream, that means that the sales are overstated by that amount. So I'm going to add those two together, and we're going to reverse that. So the revenue has a credit balance. We're going to then debit the revenue for that amount. Now you would think then the other side, there's kind of two ways you can do this. You could do this yellow journal entry down here is just to do this in a one-step process that might be easier because it kind of ties into our worksheet, or you can kind of think about this in a two-step process. So because you might think, well, there's the revenue account. Maybe I should be reversing the cost of goods sold related to it, which would be then the 66,600 and the 50,000, which would be reversing that, and then the difference being inventory. So you'd say the 186 minus the 116,600 would give you the difference, the plug, which you need to be in balance, which we're going to record to inventory, the 69,400. And then you would need one other adjustment to make this work out, and that's going to be the inventory for the 29,300, the 29,300 being the amount from our worksheet, the amount S resold. That's going to be this 29,300 here. And, well, you could take the amount resold for both, but the other one is 0. See the amount that was resold in the current year by both S and P, but P didn't resell anything. So it's the 29,304. And then inventory would be debited, and we would credit the cost of goods sold. This is what's been posted into our sheet here. And that should line up. Now, the other way you can think about this is you could say, okay, well, let me do it this way. I'm going to say, instead of doing these two entries, I'm going to get the same 186,000 by taking the two revenue transactions. I know I need to reverse the revenue for the current year because they're intercompany transactions. And then I'm going to think about the cost of goods sold, and I'm going to pick that up from our worksheet. So if we just use the worksheet approach, we can say, okay, last journal entry basically took into consideration these two numbers, right? The activity from the prior year. So we really just need to take in the current year numbers somehow, these two numbers. So the 1596 and the 25,000, these are basically, we're not going by up and down. We're basically, going the current year now. So the 15,096 and the 25,000, that's going to be the 145,904. So you could say, okay, I'm going to debit the 186 in accordance with the current year revenue. I'm not going to reverse the cost of goods sold related to it. Instead, go into the worksheet that we put together down here to pick up this 1596 and the 25, and that'll be the credit that you're going to be having for the cost of goods sold. Then the difference would be going to inventory. So in other words, if you were to take this and compare these two approaches, so you might want to just kind of think about it from a couple different approaches. The second one's probably a more easy, systematic way, given the worksheet, given the fact that you're saying, hey, look, I did the top half, now I'm doing the bottom half. It's kind of a journal entry type of format. If you took the cost of goods sold, the 116,600 minus the 29,304, that's going, I'm sorry, is that right? Let me do that again. 116,600 plus the 29,304 for the cost of goods sold, and the cost of goods sold here, that's where you get the 145,904 here. And then the inventory, same thing. If I took the 69,400 plus or minus this time, minus the 29,304, that would give us our 40,096. So there we have that. And then we posted this out over here. So this is our ending numbers. We can see this is 0. So that makes sense to us. That's 0. That makes sense to us. And this 18,300 at this point ties into our worksheet down below, the 18,300. Now this might not always be the case because we might have other adjustments in future problems that are other than just this reversals of the intercompany transactions. But right now that we could see that as a check as well, and we've basically reversed out the S's equity section, so we can use that. And so in other words, these equity section kind of represent P's equity section. So those are some things we can use as check figures on our work.